Good afternoon. Welcome to Deloitte's Debrief Tax webcast series in Asia Pacific. Our webcast today is from our Geographic Update series and is titled Hong Kong's New Legislative Bill on Company Re-domiciliation Regime. My name is Kai Yan, and I'm a tax partner of Deloitte China, based in Hong Kong. I have the pleasure of hosting today's webcast. I have one speaker with me today, Kenneth Lee. Kenneth is counsel at Chan & Jamieson LLP, which is an independent Hong Kong law firm associated with Deloitte Legal. He is also based in Hong Kong. You may access our bios on the left side of the screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are on listen-only mode. If you have any content-related question, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your questions during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. And on the other hand, mobile device users can view the slides and answer the survey on screen. Thirdly, if you require an attendance record for this event, you will receive an automated email with CPE certificate after watching for 15 minutes. Now, with the house rule set up, I would like to go through with you our agenda for today. Now, let me give you an overview of the topics that we will discuss today. We will split the topic into three main sessions. Kenneth will cover the first topic, giving an overview of the proposed legal framework of Hong Kong's company re-domiciliation regime. And I will cover the second part to discuss about the associated tax treatments of re-domiciled companies to Hong Kong. And in the third part, Kenneth and I together will discuss on the potential use cases of this new legislative bill. If we have time at the end, we will also cover some of your questions. To start with, I'll now pass the time to Kenneth.
Thanks very much, Karian. So today we'll start off, before we start off this presentation, we'd like to do a quick polling question. And our question at first is your company interested in re-domiciling it to Hong Kong? And I guess we could give everybody a minute or so to see the results. It'll be quite interesting to see what everybody's thinking about this new regime. So Karian, I think when we are looking at this, we definitely do see in our client base, we do see that there's a little bit of interest from Hong Kong and also international clients about taking advantage of re-domiciliation, right?
Yes, so the bill has been anticipated by the public for months, and in the past discussion, most of the clients were considering like a wait and see approach to see like how easy the legislative framework will be, how convenient, how straightforward would be, and what would be the tax implications for utilizing the bill. So so let's see, if this will change after the introduction of the details of the regime in this webcast.
Okay, just give a few more seconds. So yeah, it looks like we're about even on yes and no, and actually most of the response, about half is maybe. So hopefully throughout this discussion, we'll be able to discuss more about this proposed regime, and afterwards we'll find out more, and people will have a better sense of what this re-domiciliation regime is about and what advantages it brings to our daily corporate work. So we can move on to the next slide. So I'll start off first to talk about the legal framework. Just by way of introduction, my name is Kenneth. I'm a counsel/director with Deloitte Legal Hong Kong. We operate under the name of Chan and Jameson, which is a member firm of the Deloitte Global Legal Network. So, as you will be aware, over the course of last year, the Hong Kong government has completed consultations on the new legislative regime for re-domiciliation. And with the conclusion of the consultations, which is in favor of this new regime, we have now come out with draft legislation to allow companies to re-domicile, which basically means a company that was originally incorporated in overseas jurisdiction can now migrate their place of incorporation to Hong Kong, becoming a Hong Kong incorporated company in the process. So the current status is that, as you know, in Hong Kong, with legislative amendments, we have to pass first, second, and third readings in LegCo. So early in January, the draft bill amendments, which is about 300 pages long, covers a number of existing ordinances, was passed first reading, and actually, as of today, what's happened so far is that the legal services section of the LegCo has published a report on the bill, basically in support and generally supportive and explaining some of their views on the law. And today, actually, simultaneous with this meeting, actually, there's a LegCo meeting of the Bills Committee where they will further consider the bill between the LegCo members in the committee, as well as various members from the responsible government departments, such as the company registry and the IRD. So we look forward to continuing developments. Right now, I don't believe, at least publicly, no dates for the second and third readings has been set yet, but it does look like this is a law that has general support. So we do expect it to pass soon in the near future. So just to so the general sense is that, at least from the lawyer side, this new regime to me actually brings us more in line with international standards. Basically, out of Deloitte Tax and Legal, we run a lot of corporate reorganizations across multiple jurisdictions. So oftentimes we actually do get questions from multinational clients at Deloitte, often Europe. So they would come up with these elaborate plans for global reorgs. And sometimes they would say, oh, so I'm moving companies here and there. And in the Hong Kong part, I'm going to do a re-domiciliation. But then we'd have to tell them, no, you actually can't re-dom in Hong Kong. But especially to European Deloitte tax teams, they're often quite surprised because in a lot of European jurisdictions, re-domiciliation is in place, and they use it quite frequently because it has certain advantages over an asset transfer or share transfer. And we'll look at that more in detail later, why it has certain advantages. In any case, I'd say this is an additional tool in the toolbox for lawyers and tax specialists in terms of doing corporate restructuring. So hopefully after this discussion, we can give a better sense of why it's a new tool that can be used in various use cases. So again, the policy, from a policy-wise, it's expected that the new regime will help to attract offshore companies to establish headquarters, operation divisions in Hong Kong. And like I said before, in a lot of multi-jurisdiction exercises, this does give an easier route to establish a headquarter or regional headquarter in Hong Kong. And that's because it is going to provide a more accessible and streamlined road for international businesses looking to integrate into the local markets while preserving existing corporate structures. And we'll talk a bit more about what we mean when we preserve existing structures. The final point we make is that the once you're re-domiciled, obligations applicable to Hong Kong incorporated companies will apply to a re-domiciled company. So as we said, a re-domiciliation means you change your place of incorporation from overseas to Hong Kong. So naturally, Hong Kong requirements or obligations for a locally incorporated company now applies. Next slide, please. So as I mentioned, the current draft bill that's in the LegCo is a long one. It's about 300 pages, and it covers quite a number of ordinances. I'm just listing the main ones here. There are a few more. As you can imagine, this is because a lot of these are administrative changes, mainly to make sure that whatever apply to Hong Kong incorporated companies, the wording in the legislation now applies to re-domiciled companies. So some of the big ones, obviously, companies ordinance and the business registration ordinance will have to be changed to reflect the new regime. The inland revenue ordinance will also be changed, and Kai will tell us more about how the treatment of transitional tax matters will apply for a re-domiciled company. And finally, insurance and banking ordinance are also changed to accommodate for the fact that you may have companies that used to be foreign incorporated banks and insurers, and now they will re-domicile in Hong Kong. And in fact, in earlier consultations, this was one of the key targets for having such a regime because the government expects that there would be overseas incorporated insurers and banking companies that want to re-domicile to Hong Kong. Specifically, the major changes, obviously most of the changes are to the company's ordinance, and a new Part 17A is proposed to be introduced to the company's ordinance with new sections describing this entire new framework on treatment of re-domiciled corporate entities to Hong Kong, including eligibility requirements, which we'll briefly talk about, the application process, as well as compliance requirements. In terms of the, there's also a number of new schedules. The new Schedule 6A to Part 17A talks about the application requirements, including what information and statements have to be provided. 6B talks about new particulars to be provided for directors and company secretaries of these domiciled companies. And as you can imagine, as we mentioned before, once you re-domiciled, the applicable requirements to a Hong Kong incorporated entity now applies to re-domiciled company. So even if your original jurisdiction, you didn't need a company secretary, you now do need a company secretary as a Hong Kong incorporated company. 6C includes documents to accompany the re-domiciliation form, and there's a number of them. For example, we'll be talking about the legal opinions that will be required. Next slide, please. So in terms of the key features of the regime, first of all, once you re-domicile, we've been saying that your legal identity is preserved. So this really is without the need to create a new legal entity. So this really is in contrast to before this regime. How could you migrate a business organization to Hong Kong? Normally, you would set up a new subsidiary in Hong Kong as a brand new incorporated company. If you re-domicile the company to Hong Kong, then there's no such issue. You're not actually setting up a new company. The existing entity is preserved, which means there's business continuity. That is, whatever the company used to own, its property, as well as its rights, obligations, and liabilities that stem from whatever contract it is already party to, which include financing, customer, supplier. All those relationships, those legal relationships will remain after the movement of change of place of incorporation. Also, in the consultations, the government has made clear that if you are an existing registered non-Hong Kong company, your company name and the business registration number will be retained. And so we will actually compare a bit in the next few slides about what's the difference between just doing a Part 16 registration versus re-domiciliation. Finally, because you, as mentioned before, a re-domicile company has the same rights and obligations as a local incorporated company. So you are bound by the regular filing requirements and your returns as well as the audit requirements that anything that applies to a Hong Kong company, you are now bound by it. Next slide, please. So I think some of us already wonder how does it compare to the existing ways of migration. I think it's easier if we illustrate here by a simple table. It's a broad summary of features. I think if we were to there's many other reasons, but I think these are some of the key features comparing the different ways of, let's say, what we would call a relocation of a corporate. On the left two columns is the basic methods of setting up a business in Hong Kong that you would find if you were just open to any sort of how to establish a business in Hong Kong guide that you can find online. So the first option is usually to set up a new Hong Kong subsidiary that's local incorporated. The second way would be set up a branch. Branch is a colloquial term. Legally, that refers to having a registration as a registered non-Hong Kong company, or Part 16 registration under the CO. Those are two ways normally, and then now with the re-domiciling regime, we have a third, basically a third tool in the toolkit for sort of how you relocate a business to Hong Kong. And perhaps it's easier if we go from left to right. Let's examine the having a new Hong Kong subsidiary that's locally incorporated. So this would mean, let's say I have an overseas incorporated company, and I like to migrate it to Hong Kong. So you would set up a new legal entity in Hong Kong. That's technically a new company. So it's a fresh company, and accordingly, at a start, it has no liability of existing overseas entities. So that means that it's a fresh entity, and what you would need to do is you would need to transfer over all of the assets of interest to this new entity. So this would mean if you have customers, if you have suppliers, the contracts of these customers and suppliers. So you would have to transfer employees over as well, and this is usually a costly and not straightforward process to execute. You'd have to enter into, for example, if there's financing, you have to novate, and you may have to get the bank's approval to do the novation. If you do employee transfers, we've seen in typical sort of these corporate or / M&A transactions, sometimes at the transfer process, the employee will use that as a way to, if you tell them you're now getting hired, terminated, rehired back, even you tell them you're offering them the same terms and conditions. Sometimes you have clients that are worried, oh, if we tell them that explicitly, then some people might just leave, right? Similar for customers and suppliers. So also on the previous point, no liability transfers. But if, for example, under Hong Kong law, if you do under the Transfer of Business and Protection of Creditors Ordinance, when you transfer a business, unless certain notice requirements are complied with, the liability does transfer. So whether your new company is completely free of liabilities from the existing entity is a technical position, and you have to study it on a case-by-case basis. Also, on the first point, under disadvantages there, if you were to do a transfer back to a new incorporated Hong Kong entity this way, you'd have to wind up our existing overseas entity after the transfer. Presumably, it's become an empty shell, or alternatively, as we see with some of our clients, and what's driving this desire to re-domicile actually is over a course of time, especially I think a lot of bigger Hong Kong conglomerates, they're left with many shell of offshore entities that they're not using anyways. So they end up just paying compliance fees annually, but they're just standing there. And you either have to wind them up, or there's some other way to take care of them. So it's also a disadvantage to setting up a new subsidiary. Finally, if the overseas entities assets include shares in Hong Kong companies, or another company where transfer of shares attracts Hong Kong stamp duty, that's another issue. We come with that often. If you have to transfer, let's say a offshore company holds like 3 Hong Kong companies, then you try to transfer that to a new Hong Kong subsidiary, and you just end up paying actually significant size of stamp duty depending on the value of the company. So that's another problem or a cost associated with this. Generally, this whole process, you get legal and your accounting and your finance and your legal advisors in, and it costs a bit of money as well. The second option on this column is just setting up a branch. So this is just what is a Part 16 registration in Hong Kong. It's quite simple. Usually we'd say 2 weeks. In a complicated case, we've seen 4 weeks. So in this case, you're not setting up a new entity. You are just, the existing overseas entity remains. It's registered in Hong Kong. And there's a privacy advantage for that. It really just applies to if you're in an offshore jurisdiction where, let's say, a Caymans, where you don't have any way to search a company's shareholders or directors. So even after you register in Hong Kong as a branch, you still retain that privacy advantage if that's so desired by the client. Again, also in such offshore jurisdiction, generally no stamp duty. So if you're thinking there'll be in the future lots of share transfers at this company, then you save on any sort of applicable stamp duty as well. In terms of disadvantages, over the recent years, one of the disadvantages we've heard clients complain about is they're not sure about the tax compliance position. They're not sure. There's often a lack of clarity about this tax residency of such a company. Also, you now have to comply with requirements both in Hong Kong as a branch and your local compliance filing requirements in the original jurisdiction. So that's admin effort, that's admin costs. You have to find outside advisors to do it, especially for offshore companies. You're getting a Vistra as a registered agent, etc. Finally, and that's just my experience, is in the Hong Kong market, while it's true that yes, a foreign incorporated company is just fine. You can contract with customers, suppliers in Hong Kong. There's no legal barrier to doing that. In practice, it's true that some companies do have a preference to deal with local incorporated companies. We see that most often, actually not just in commercial work, but even in family office work nowadays, that you see clients trying to open bank accounts with their corporate entities. And we do find that for Hong Kong banks, they tend to have a much easier time and they're much happier to have a very fast process of opening bank accounts for local Hong Kong corporate bank entities, versus if you show them a Cayman, some banks would outright say, I don't want to open a bank account for offshore entity. Of course, it depends on who the ultimate owners are, but that may be an issue to think of when comparing these different ways of setting up in Hong Kong. So now going on to the proposed re-domiciliation regime. So it's, again, I categorize, we have a new tool in the tool shed now for relocating to Hong Kong. As we've mentioned, because you are maintaining the existing company, you're just changing its place of incorporation by legal procedure. So there's no transfer of assets that's going on. Whatever is held by the overseas entity continues to be held by overseas entity. There's no transfer, meaning there's no, if you're holding any Hong Kong shares or any other shares that have stamp duty for share transfers, there will be no stamp duty to pay. That's usually a big one. And similarly, you won't have to do any like transfer or assignment or novation deeds to make sure your agreements get assigned or novated from one company to another. Everything gets preserved. And again, with the preservation of legal identity, similarly, because you're just re-domiciling, actually you wouldn't have an issue where you're setting up a new Hong Kong entity that's fresh with no history. So in practice, how I've seen this is, let's say most recently, we were helping a actually one of the tech startups that we're very active with advising on in the Hong Kong Science Park, and they're about to sign some big client contracts. They locked down a big Hong Kong conglomerate, and very happy about it, about to sign the contract. And then we noticed that their counterparty was a unknown Hong Kong company. The name has no relation to the bigger conglomerate, and when you search it, it's just newly incorporated. So naturally, when you have things like that, you see someone trying to contract with you with a company that was only incorporated a month ago, it does raise alarm bells. People have questions whether that kind of newly incorporated company has any actual assets. Can it pay me if I were to sue it? If it owns me anything, how can I enforce it? Or why don't we just it could just wind up, right? If anything goes wrong and there's a legal liability attracting it. So there's value to preserving legal entity. The history is one way. I'm sure we can think of many more reasons. Finally, you only would need to comply with the Hong Kong reporting obligations. We'll explain later, but once you re-domicile, you'll be required to deregister in your original home jurisdiction. So those are the advantages, but of course, it's not all advantages. There may be some disadvantages. So the biggest one probably, which is the disclosure obligations. If we're comparing a Hong Kong incorporated company versus, let's say, a Cayman or BVI, definitely Hong Kong company, you have to file annual returns. So your shareholder, your directors is open for the public to see. Your articles can actually be downloaded off the company registry. That's not the case for Cayman BVI, although we'll actually talk a little bit about that, about why people's thinking about that may be changing. Also, a Hong Kong company generally needs audit requirements. So if you're coming from a jurisdiction that doesn't require an audit, that's another thing for you to do. You need to pay for an auditor, etc. Next slide, please. So we've gone through a little bit of introduction. So another polling question is, would you think the proposed re-domicile regime makes Hong Kong a more attractive place? So let's see, give us a minute or two to do this survey. And I think in the meanwhile, thanks so much. We've got a lot of participation in the Q&A. I think one of the questions was if you re-domicile in Hong Kong, you have existing contracts, what happens? So if you re-domicile, and I'll talk a little bit more about this later too. I think the situation may not be too different from existing corporate procedures in Hong Kong, such as amalgamation. So obviously in Hong Kong, there's no barrier to a Hong Kong company signing an agreement that's governed by the laws of another jurisdiction. Most commonly seen investment agreements, for example, in a Hong Kong company, if you invest overseas, you don't always sign in Hong Kong law. It depends on bargaining power. If I invest in Singapore, often documents are governed by Singaporean law. A similar case for Indian contracts, Indian law governed contracts, it will continue to have force. I think to go in a little bit in more detail, rather if you have an Indian law contract, I think it will continue to be interpreted by Indian law, and also what's probably more important there, at least on first thinking about it, is the dispute resolution. So I mean, normally thinking, if this company in question becomes incorporated in Hong Kong, it does not change the dispute resolution provisions in the Indian law contract. For example, a dispute resolution talks about where you sue if there's a dispute. And normally, I think a lot of commercial contracts, let's say, for example, it says you have arbitration in India, then that continues to apply. So it doesn't matter if at first I was Cayman Incorporated, like many Hong Kong businesses are, and now I become Hong Kong Incorporated. That position doesn't change. If I was sued under the Indian government contract, I still have to carry out the arbitration under the Indian Center of Arbitration, or whatever procedure was applicable. We'll talk a little bit more about the transfer of contracts in some of the later slides. So when the results are in, I think there's interest. I'm very happy to see that very few people are saying no interest, and there's some people are still saying, most people are still saying neutral. So I think it's hopefully after this, we'll explain why it's a new tool set, new toolbox, new tool in the toolbox. It does get a little bit technical, and we'll I think in some of the use case it'll become apparent if we were to plan a tax-based or finance-based restructuring. The re-domiciliation regime does come into in as a handy option to consider. So let's go and move on to the next slide. So just quickly, let's go into some of the eligibility criteria. So under Hong Kong company, we have a number of companies that people can incorporate, right? The current proposed legislative bill says that whatever a company is incorporating in has to fit within the one of the four kinds of company on the slides. I think typically we'll more likely be doing with the private companies limited by shares, maybe some public companies limited by shares. I think what's interesting here is what's left out here is companies limited by guarantee in Hong Kong, and those are mainly associations or charities. So for obvious reasons, it's not included as a one of the types of company that can re-domicile. Next, please. And just to quickly go over, well, this is not the focus of today's discussion. As I mentioned, one of the policy reasons for the re-domiciliation regime was that there may be interest for overseas banking companies and insurers to re-domicile to Hong Kong. And over the course of my work, we do notice that I've come across M&A deals where you have reinsurers or insurers that are incorporated in Cayman or Bermuda, but they're actually mostly active in Hong Kong. They tend to be very small companies that do this. Basically, right now, under the amendments, the re-domicile financial institution will become subject to the same regulation as a Hong Kong incorporated bank or insurer, so it makes sense. And the most important amendment is just to say that if such an insurer or bank is thinking of applying to the CR to re-domicile, it should first go and consult the insurance authority and the HKMA to get their approval first. So we'll wait further approval procedures from the relevant authorities in that regard. Next slide, please. In terms of other criteria, as I mentioned, number one, you have to fit a specific company type. Number two, very important, is that the overseas jurisdiction's law allow you to outwardly re-domicile. Obviously, if your incoming jurisdiction's law prohibit re-domiciliation, then, or doesn't say it provides re-domiciliation, then you can't re-domicile into Hong Kong either. And you will have to provide evidence that the original jurisdiction allows re-domicile and out, and we'll examine, have a quick list of countries that allow re-domiciliation out in the later slides. Interesting to note too, the current proposal in Hong Kong, we've proposed to establish a domicile into Hong Kong regime. In the consultations, the government said there's still, right now they're not planning to have the re-domiciliation out of Hong Kong, which actually puts us in a similar position as Singapore. So another requirement, the applicant must have been in existence for at least one financial year. I think that's pretty common sense. Also kind of a substance requirement. In terms of shareholders approval, the local shareholders consent must be obtained. If there's no local requirement for shareholders approval, then at least 75% of shareholders must have approved the re-domiciliation under our local billing proposal. There's requirements that the application has to be in good faith and not intended to defraud creditors, which similar to business transfer ordinance requirements. So obviously the applicant can't be in liquidation, and there's a requirement that the board has to make a statement that the company can pay its debts in full within a period of 12 months. So that's more of a responsibility or liability on a director's issue. Again, the company registry has a veto power under this proposed bill. If it considers that the company is likely to be used for unlawful purpose or a purpose contrary to public interest, it can deny the application. Next slide, please. So for lawyers, I think one of the requirements jump out is that it requires a legal opinion. There's a schedule that sets out the various requirements for a legal opinion. So if we were to assist, obviously we have lots of experience of doing this from Deloitte Legal and Deloitte Tax. We will help you find either within our global Deloitte Legal network or align with other offshore counsel to handle this legal opinion. If it's a offshore company, such as a BVI or Cayman company, we're happy to say that Hong Kong already have a substantial number of practitioners that already do this based on discussions with our usual offshore counsel partners. It would just take maybe in a very simple shell case, probably takes a week to prepare such a legal opinion. And the legal opinion would say things like common things like it's duly registered, it's validly subsisting, and that it fits one of the 4 types of companies allowed for incorporation in Hong Kong. There's no disqualification of directors. Some of the key items is that it should opine that the original domicile allows re-domiciliation, and that requirements, if there's any government requirements to re-domicile, it has already been obtained, and that members' shareholders' consent has been obtained. And finally, there's no petition for winding up, there's no liquidation, there's no insolvency, and that you can deregister the company, because as I mentioned, a Hong Kong local requirement is that we must deregister the original incorporation. You can't be incorporated in both places, which again makes common sense. Again, we already have local talent in Hong Kong to do this if it's a BVI Cayman, because there's already a lot of re-dom work that's being done between the offshore jurisdictions, actually from Bermuda, BV, and Cayman. We do see even of our listed companies, there's existing activities where people are re-domiciling between these 3 jurisdictions. So offshore counsel already have experience preparing this kind of continuation pack. Where it comes to a more difficult jurisdictions, maybe somewhere in Europe, then it may get more complicated, especially if the company has actual operations. That's also where we expect things to get more complicated too, and it'll be on a case-by-case basis. Next slide, please. So before we end off, just a very general survey of where re-domiciliation is already allowed. As you can see, big long list of places where re-domiciliation is already allowed. Some asterisks there, and that's because in some places they allow our re-domiciliation, but we can go on next slide too as well, Perry, thanks. They allow re-domiciliation, but only to a specific list of existing locations. So once Hong Kong's regime comes into place, we'd expect that Hong Kong will become included as well. Next slide, please. So it's very general guesstimate on the timeline. We normally expect maybe you'll take 10 to 15 business days to prepare the submission to the CR, and upfront and consultations, the government has said they expect CR processing time to be 2 weeks. Of course, in actual practice, you'll see that the regulators can always say, oh, well, your application isn't complete. We were requesting more documents. So then I think 2 weeks is a very optimistic case. And if it's a shell offshore company, yes, 2 weeks is might be possible. And if it's 2 weeks, then you can say that, yes, it's a much more easy process than doing a business transfer. After you do the re-domiciliation, again, you need to provide evidence of deregistration within 120 days, which can be extended. If you cannot provide deregistration, you will be forced to cancel your re-domiciliation application. So that's the legal end. Before we move off to tax, another polling question just to survey what we think. Next slide, please. So what are your biggest concerns so far regarding re-domiciliation to Hong Kong? Is it compliance with Hong Kong regulations, the application process, the registration, or transferring assets and liabilities? So we'll give another minute to run through it.
Thank you, Kenneth. And while we are waiting, I think we can pick up 1 or 2 of the Q&As we have got so far. So one question we have received is, do the authorities look at the economic substance requirement in Hong Kong at the stage of re-domiciliation application? Actually, for all three options, in order to establish a company in Hong Kong or re-domicile a company to Hong Kong, there are no specific economic substance requirement. However, there are certain economic substance requirement under different tax rules. So in other words, it's legitimate to establish or re-domicile a company to Hong Kong without any economic substance. However, in certain circumstances, it may result in adverse tax implication in Hong Kong. Say, for example, in the absence of economic substance locally, Hong Kong property tax may be due on certain types of income. Yeah, so let us now take a look at the result of the polling question 3. So yes, so as we sort of expected, most of the concern would be potential concern would be the Hong Kong regulations, compliance, and how to deal with the deregistration in the original jurisdiction, and whether there would be any transactional costs and transactional tax in the course of the asset and liability transition. So in the next slide, in the next session, we will talk about the tax consideration as well. I see it is also being asked in the Q&A, what are the tax side of the consideration. So before we start, just a recap, as Kenneth has rightly mentioned, currently there are two options, largely two options to do, to move a business to Hong Kong. First option, as Kenneth mentioned, was, establish a new Hong Kong company, transfer the contracts, the assets, and the liabilities to the Hong Kong company, and then wind down your original overseas company. The second option is a Hong Kong branch registration, or we commonly call it a Part 16 registration. And now under this proposed legislative bill, we are happy to see we have got the third additional option, Hong Kong re-domiciliation. And in the slides that follow, we will try to compare, what are the differences in these options, these three options. So for here are a recap of, the major tax consideration in the course of re-domiciliation, considering whether to re-domicile your company or not. First of all, in the proposed legislation, Hong Kong tax residency status has been amended to include, re-domicile company. So in other words, in both the company's ordinance and in both the Hong Kong Inland Revenue Ordinance, it would be clear that the re-domicile company to Hong Kong will enjoy the same status as a Hong Kong incorporated entity. Why does that matter? Because in most of the tax treaty of that Hong Kong has, the definition for qualifying as a Hong Kong tax resident is different for local company and overseas company. So for a Hong Kong incorporated company, it would qualify as a Hong Kong tax resident. And for companies that incorporated in overseas, you would have to prove the company is normally managed or controlled in Hong Kong in order to be recognized as a Hong Kong tax resident. In here, it would be clear that, a re-domicile company would clearly become a Hong Kong tax resident, while in the other cases, say for example, Hong Kong branch registration, it would be more unclear to define, whether the entity is a tax resident of the Hong Kong where the branch locates, or the tax residency of the overseas headquarter location. Secondly, Kenneth has also briefly mentioned, once the company is re-domiciled to Hong Kong, it will have the same status, rights and liability as a Hong Kong incorporated entity. So In other words, future transfer of the shares in the company of the re-domicile company will attract Hong Kong stamp duty like any other Hong Kong incorporated companies do. And also it will be subject to annual audit requirements. So comparing to Hong Kong branch or Part 16 registration, this is not the case. Transferring of shares of Hong Kong branch and also would not attract Hong Kong stamp duty, and also Hong Kong branch would not be subject to Hong Kong annual audit requirement. And the third consideration is if we try to re-domicile an overseas entity to Hong Kong, whether or not it would trigger any overseas tax clearance requirement, and if there are any exit tax resulted in the overseas. If we are talking about low tax jurisdictions such as BVI, Cayman, Bermuda, probably it would not be the case. However, if we are trying to re-domicile companies in high tax jurisdictions such as European jurisdiction, European countries, then this is probably a major point to consider before we make any action. Look at the right-hand side. The fourth consideration we would have would be after re-domicilating the company to Hong Kong, we would have greater flexibility for future entity rationalization. One example is for Hong Kong, for two entities, one is Hong Kong entity and the other is non-Hong Kong entity, even if it has a Hong Kong branch registration. The two of them cannot be merged together. However, there will be a framework under Hong Kong Companies Ordinance to allow Hong Kong company amalgamation between two Hong Kong companies. And this would be available for re-domicile company as well. So imagine the BVI entity, after it is re-domicilating to Hong Kong, it can easily amalgamate, or we say merge with another Hong Kong entity easily. So that would give our MNC clients more flexibility on their future group restructuring. The fifth point to be considered would be whether the action of re-domiciliation would result in any double taxation, and if any tax is resulted in a jurisdiction without a tax treaty with Hong Kong, would any unilateral tax credit be allowed? We will go through that in the next slide. The last 2 points are transitional tax measures. Right, so in this slide, we will talk about what are the Hong Kong profits tax transitional tax measure of re-domicile company. Before I go into the details, I want to give everyone a background. So Hong Kong adopts territorial source principle. Whether an entity would be subject to Hong Kong profits tax is not dependent on its place of incorporation. It's dependent on whether or not it has commenced a Hong Kong business. So these Hong Kong profits tax transitional tax matters are available for entities that did not carry on any business in Hong Kong before the re-domiciliation date, but started to do so after the re-domiciliation date. So first of all, the general rule is for any pre-re-domiciliation date expenses pre-incurred before the re-domiciliation date, it could be allowed for Hong Kong profits tax deduction, provided that no tax deduction have been allowed in Hong Kong or outside Hong Kong in another jurisdiction. Second of all, specific to trading stock, the cost base would be taken as acquisition cost or its net realizable value on the re-domiciliation date, whichever is lower. Thirdly, for costs incurred on intellectual property registration, building refurbishment, and R&D expenditure that incurred before the re-domiciliation day, also Hong Kong profits tax deduction could be allowed in the first year when the company commenced to do a Hong Kong business. And lastly, for any capital expenditure and purchase of IP, intellectual property, prescribed fixed asset, environmental protection facility, plant and machinery, also any capital expenditure of these types incurred before re-domiciliation could be allowed for Hong Kong property tax in the year when the Hong Kong business commenced. And the cost we would take the market value upon the re-domiciliation date, or the historical cost minus the accumulated amortization or depreciation allowances, whichever is lower. So next slide, please. So yes, after we have talked about the legal framework and the proposed amendment to the Hong Kong tax rule, we can now move on to see what are the potential use cases. So this is a recap of the typical offshore structure that we are seeing in Hong Kong for our clients. So typically, there are upper layer of Cayman entity with multiple layers of BVI entities before the actual holding of Hong Kong and the underlying operating subsidiaries in mainland China or across the world. And the reason for this is, next slide, please. Yes, I think Kenneth has briefly talked about the reason. So mostly the consideration were, for BVI entities in the past, the incorporating cost, the annual maintenance cost was relatively low. There are no audit or tax filing requirements in BVI, Cayman, Bermuda, etc. And also there are privacy on the register of members, shareholders, and also the directors. And also transfer of shares in those overseas offshore companies do not attract stamp duty. So these are the historical costs and the reason why we are seeing such common offshore structure. Kenneth, can you share with us, is it still the case, in the recent 2 to 3 years?
Yeah, I think that's an interesting question, Karian. If we could move to the next slide. Yes, all of those were advantages that used to come with an offshore jurisdiction like a BVI or a Cayman. Very, very popular with Hong Kong conglomerates. But I think we do see a trend where, because of also even on these offshore jurisdictions, there are more and more calls for great disclosure or AML concerns. So some of these advantages we could say may be changing to the point where we would say we may argue whether there's doubts whether there's so much advantages of having such an offshore incorporation. For example, in terms of admin work, I think at least for BVI, they recently passed a requirement that companies have to file financial statements, although they're still unaudited. So still a bit better than a Hong Kong corporate company where we need to audit. In BVI as well, you have to make a filing on economic substance requirements as well. So that hits in terms of maintenance costs, you have to find your advisors to make that annual economic substance disclosure. And generally speaking, I think in terms of maintenance costs, I think if we're locally sourcing company secretarial fees, I think the cost of maintaining a Hong Kong company is now very, very low. I think if you, obviously Deloitte, we can do it, but if you go out on this market, you find there's single practitioners online advertising extremely low maintenance fees. So we can say that there's a increased maintenance cost, and especially we've been talking about big conglomerates that have set up a very complicated BVI structure. In the previous slide, we saw like 2 BVI layers. They had wanted to set this up because they wanted flexibility for financing or to provide share collateral for security when they did the financing. And then turns out they never used this for 10 years, and they paid 10 years of compliance fees to the government in BVR Cayman, and they paid the register agents admins as well. So those accumulate. And finally, in terms of privacy and disclosure point, we do see some movements away from absolute privacy. Right now, it's true that in BVI and Cayman, you still cannot search the register of members. But I think for BVI nowadays, you can search the directors. And also, we see more and more requirements. It's not a public disclosure, but you're having to make filings for ultimate beneficial ownership to the authorities. So you still have the advantage of no one can search your shareholder now. But that's moving as the world becomes more and more concerned with AML issues. We may see more movements towards greater disclosures. And in any case, another interesting observation we've had is that some people, some conglomerates, especially family business, simply realize that they don't care about the privacy. It's fine to be known that that entity is held by the family or by the business. In any case, if, for example, if they have a listed company somewhere, annual reports will be published, and the annual report mentions all these offshore companies anyway. So no one has any doubt who is actually holding these companies, making your advantage in privacy redundant. Thanks, Karin. On to you.
Yeah. Yeah. Next slide, please. Another thing for using as a reason for using multiple layer of offshore entity was, you can easily sell out the mainland operating entity through sell in the BVI level. So it would result in an indirect transfer of shares in the operating entity instead of a direct transfer of shares. And after doing so, you can liquidate the seller entity. So it may work in the past. However, since a lot of jurisdiction, there have been tax law catering for indirect share transfer. So this may no longer be a way in the future either. If we are going to restructure these BVI entities by doing, re-domiciling the BVI entities to Hong Kong as a Hong Kong entity, then in legal sense, probably there would not be any transfer of the underlying entities, because we are not transferring the underlying subsidiary, but just changing the place of incorporation of the parent entity. So next slide, please. Also, there are many other considerations on how the offshore structure may work in the future. In the Pillar 2 environment, there will be detailed disclosure requirement under the Global Information Return GIR on the jurisdiction and TIN number, tax identification number for each constituent entity. We have shown screen here. Next slide, please. Also, another recap of the upcoming GIR detailed ETR, effective tax rate calculation, for each and every CE in each and every jurisdiction would be required. So if the offshore entity remain to be BVI, Cayman, Bermuda entity, then they would be disclosed to the worldwide tax authorities through the GIR filing. So there is a reason why do we have to consider registering them in Hong Kong or re-domiciling them to Hong Kong. Next slide, please. Yes, so also for Hong Kong, for overseas entity that only has a registration in Hong Kong, we have briefly mentioned about the economic substance requirement. So in short, if the Hong Kong taxpayer has derived any offshore gain or offshore income, such gain or income could be subject to Hong Kong property tax if it does not have the adequate economic substance in Hong Kong. So this is something to be considered when considering, re-domiciliating companies, offshore companies to Hong Kong. Next slide, please. Yes, before we move on to the three scenarios, here is a quick polling questions. So after our sharing up to now, what do you see as the most beneficial aspect of re-domiciling a company to Hong Kong? One, Hong Kong's geographic location. Second, Hong Kong's tax regime. Third, streamlined and transparent compliance regulations in Hong Kong, or others, or don't know. I think in the interest of time, we will cut this polling question short to leave some time for going through the three scenario structure. So if we can push the result now. Yeah. So seems like Hong Kong's tax regime, with what we have introduced, and also the streamlined and transparent compliance regulation, are still quite appealing to MNCs on considering the re-domiciliation to Hong Kong. So next slide, please. Kenneth, we have here three common scenarios with MNCs which could consider the Hong Kong re-domiciliation scheme, right? The first structure is a very commonly seen red chip, what we call red chip structure. So in the first layer, there is a Cayman or Bermuda incorporated entity that is listed in Hong Kong, and beneath that would be a BVI intermediate holding entity, followed by a Hong Kong holding entity before the underlying operating entities in mainland China. So
yeah, that's right. Yes, that's right. So
in the recent policy address, I think the Hong Kong CE has mentioned that as soon as the legislation framework is enacted, it would encourage most of the Hong Kong listed entities to re-domicile the offshore entity to Hong Kong. In this case, it would be the Hong Kong listed Cayman Incorporated or Hong Kong listed Bermuda Incorporated entity, may be the first batch of entity that would embrace the new legislation and re-domicile the listed entity back to Hong Kong.
Yes, that's right. So for a listed company, I think on top of what we've already been discussing, I guess the additional, I wouldn't really call it complication because I'm sure this would be something that is in line with our government policy and is very much encouraged. But with the Hong Kong Exchange, we'll need to make the relevant public shareholder announcements as well as to get shareholders' approval, which generally involves the preparation and publication and perhaps vetting with the exchange of a shareholder circular, wherein we explain this procedure and why shareholders should approve the relocation or the re-domiciliation back in Hong Kong. But given the policy impetus, we think this would be relatively a smooth process, although definitely it will be a longer process than, let's say, we're talking about a shell company that just takes 2 weeks to transfer back over.
Yeah. So if we move on to the next slide to see scenario 2, case 2, it would be a similar structure, but there are multiple layers of BVI entities in between. So this is also another case which we see to consider potentially the Hong Kong re-domiciliation regime, because at this moment, with BVI and Hong Kong in the holding layers, as we said, it is impossible to merge the multiple layers into one because it involves entities incorporated in multiple jurisdictions, right? Kenneth, how do you think the new re-domiciliation regime could help with such structure for streamlining purpose in the future?
Yeah, exactly. I think that's a very good point because I think I just had a case where again European Deloitte was telling me they have something exactly like the structure, and they were saying, why don't I just merge all of your companies? And I think they weren't super happy when I told them that you cannot merge, you cannot amalgamate a foreign company with a Hong Kong company. Right now, the court-free amalgamation procedure in Hong Kong is for Hong Kong incorporated companies. So right now, before the re-domiciliation regime, what you would have to do perhaps would include you would have to, if you're getting rid of BVI companies, it would mean the first BVI company that holds the Hong Kong company will have to sell the shares in the Hong Kong company to the HQ. And then after the sale, assuming those two BVI companies are just holding companies with no assets, you'd have to dissolve them. So with the re-domicile regime in place, what you could possibly consider is to re-domicile the BVI companies over to Hong Kong first, and then you amalgamate the resulting Hong Kong corporate company with with the Hong Kong entity, so that there's no need to do any share transfers, which again incurs stamp duty, and it's a bigger hassle. So it's an easier way to get to a point where you just have HQ holding one Hong Kong company, if that is the desire, or just HQ holding one BVI and then directly holding the Hong Kong, getting rid of the unused layer of BVI in between.
Yeah. So now we move on to the third potential use case. We would move away from BVI, Cayman, and Bermuda, and we look at European countries where it's also a common jurisdiction in the past for MNCs to incorporate holding platform, financing hub, or patent box there, such as Luxembourg, Malta, Netherlands, Cyprus, Switzerland, etc. So in the past, these are European jurisdictions which are quite effective for using as holding, financing, or patent box platform. However, in recent years, due to increasing economic substance there, it may no longer work if the MNCs are just using a shell company there, or with the help of some nominee director. So it's increasingly difficult to maintain a European companies there without actual business there. In this case, probably MNCs can consider re-domicilating these European entities to a Hong Kong, to become a Hong Kong entity as well.
Yeah, exactly. That's right. And I think in some of our earlier seminars, we were actually talking about the patent box, like you said. And at that time, we were saying to take advantage of tax advantages in Hong Kong for having IP in Hong Kong, we were saying you could do IP assignments of whatever, like if your Switzerland entity holds the patents, then just assign them over to your Hong Kong entity, and to take advantage of a better income tax treatment. But now with the domiciliation, another option besides IP assignments is to simply change the place of incorporation of whatever you're holding that IP into a Hong Kong incorporated entity. And again, that would make things probably easier in terms of the legal procedures. You don't have to enter into all the assignment agreements, and possibly avoid in terms of tax treatment, it may result in savings too when you're not having any extra transfer of patents.
Yes. So taking the example of patent box, Hong Kong has just introduced a preferential tax regime with just 5% Hong Kong profits tax rate available for patent box eligible income. And comparing with the other options, if we are going to re-domicile a overseas patent box to Hong Kong, we have mentioned in the previous page any pre-existing costs on the R&D and the patent registration could be allowed for Hong Kong profits tax deduction after the re-domiciliation. This may not be the case for the other options. Say, for example, in option 1, if we just transfer the IP from an overseas entity to a newly established Hong Kong entity, such IP acquisition costs between related parties may not be tax deductible in Hong Kong. And also for just Hong Kong branch registration, Part 16 registration, likely the expenditure incurred pre-Hong Kong registration date also will likely be not allowable for Hong Kong profits tax deduction. So taking this example, apparently using the re-domiciliation regime for relocating a patent box from European jurisdiction to Hong Kong seems to be the most preferential method from tax consideration perspective. So now I think we have go through all of our slides. Unfortunately, we have overrun a bit due to the content of the sharing today is quite extensive. We have received some of your questions which we didn't have time to go through. We'll come back to you in the next couple of weeks individually to answer your questions. Special thanks to all of you who have joined us. We would like to encourage you to fill out the short feedback survey that will pop up on your screen after this presentation. And for those who have joined us late, you can also view the presentation in the future on our debrief website. And also, thank you for your participation. We will close the session now. Thank you.
Thank you.
Bye.